The VolumeAnalyst is the most advanced volume and price action indicator available on the market today. We've combined 7 different volume and range indicators into one instance of the VolumeAnalyst indicator so that we can control all of our volume and range analysis from one tool and then select the input that we wish to use per the chart we're working with. In this video, I'm going to show you the differences between those inputs, and the input that you're looking at right now is the relative volume. So let me describe the input system first, and then I'll go into the nuances between the relative volume and the standard volume inputs. I was trying to get into this long trade here. While I'm filming this signal right here is what we're calling an extreme churn bar. It's also a major spike at a low right off of the trend line. I'm going to go ahead and get into this long if it'll pull back 2 contracts, if it will retrace a little bit with a stop just below that low. That'll be about a 4-tick stop, and I'm just looking to break that high. So it should be about a 4-to-1 if I can get filled. So it's these signals that you see created by the VolumeAnalyst that are so powerful. Volume analysis is difficult enough as it is without the aid of some indicator to describe to you what's actually happening with the volume and the price action. And what we've been seeking to achieve is a simplified analysis of what is an incredibly complex set of information, that being the volume and price action. It's really the volume that creates the prices within the bar. So volume is truly your first order indicator, and the price action is really a result of the volume that's transacted at each of those prices within a bar. So the volume creates the market, creating the prices within each bar, and the amount of volume within each bar relative to the range of the bar dictates the signals that we get. And the way that we view those signals is based on the previous price action. So what we've done with the VolumeAnalyst is add 7 different inputs, and think of each input as essentially an independent indicator. So from this drop-down menu under Options 01B Input, you have volume, relative volume, density, and relative density. Density being essentially volume per range, and then relative volume per range. And then we have range, relative range, and then volume per second. So each of these inputs runs its own set of calculations. Let's start off with the relative volume because that's what you see on the chart before you here. Relative volume is a more efficient way of analyzing the volume for minute charts. In panel 3, I have raw volume, and you can see here with crude oil in the overnight, volume is very, very low. And then you see in the European session it starts to pick up. We have a selling climax here, very high volume, and then it picks up a little bit. Volume increases on the new uptrend move, decreases on a little correction here, and then starts to pick up as the volume is pushing prices higher. And now into the open, which is at 8 a.m. Central Time, the RTH open, the regular trading hours open, volume really picks up, and then a little bit of a lull during the lunchtime, and then it drifts off into the US equities close. So you can see there's a wide variance between the sessions, between the overnight and the day session, even between the overnight and the European session. And then you have this kind of intraday seasonality effect from the morning session to the lunch session to the high volume at the close. So with the relative volume, we're removing that variance between the sessions and the seasonality from one part of the day to the next part of the day. And the way that we do this is by looking at each individual time period independently. So for instance, this bar here, that closes at 12:15 p.m. This is a 5-minute chart, so we're looking at one 5-minute bar. We're comparing the volume that transacted during this 5-minute period with the average volume that transacted during this 5-minute period over the past 10 days. So with the relative calculation, we're comparing the amount of volume for each time period relative to the average volume for that time period, yielding an output in percentage of the average. So in this case, the relative volume is 144.23% of the average. So it's 1.44 times the amount of volume that typically transacts during this time period. And you can see here the total raw volume is 5,945 contracts. And that's actually less than the amount of volume that transacted back here, which is over 9,000. and yet the relative volume output is higher here at 144 than it is back here at 87 or 133. And that's because of the seasonality during the day between the morning session and the lunch session. So the volume here, even though it's lower than the volume over here, is actually relatively much higher relative to the volume during the morning session. And that's what gives us a much more accurate analysis of the volume that's coming into the market for each individual time period. And now I've replaced the raw volume with the raw volume input for the VolumeAnalyst, which gives us all of the climax and churn signals that we would get with the relative volume, except now using the raw volume as the input instead of relative volume. So we can use this raw volume input for the VolumeAnalyst on really any chart, but you see we still have the issue of the seasonality between the morning, noon, and afternoon sessions, and then the variance between the overnight and day sessions. So when it comes to analyzing volume on the minute charts, especially the larger minute charts, such as anything over a 5 minute, it's the relative volume input that we really want to use because it provides us with a much more accurate picture of what is truly going on with the volume. You will still get fairly accurate signals out of the raw volume input on charts that are smaller than a 10-minute chart, but if I now change this to an hourly chart, you'll see the real difference. So now you can clearly see that wide variance between the day sessions and the overnight sessions. And that's fairly standard from one day to the next, depending upon reports and the market structure, the movement of trending waves or corrective waves. The seasonality throughout the day may change slightly, but the variance between the sessions is fairly standard. Yesterday, on the 17th of July, we had rollover. Rollover was really upon the reopen after the close yesterday on the 17th. So yesterday's volume is pretty low compared to the previous days as we were just about to roll over to the next contract. So you can see the relative volume is quite low during the day yesterday. So the 100% line is the average volume for each bar. Anything below that 100% line is less than average. Anything above is greater than average. And then of course we have a moving average of the bars themselves, with standard deviations to help define the individual volume signals relative to the ranges of the bars and the previous ranges of the bars. So let's go back now to a 5-minute chart and talk a little bit more about the different inputs. I'm going to change the input of the lowest panel, the third panel, to density. And density is volume per range. So we're looking at the total number of contracts divided by the range of the bar. And the signals that we get are high density and extreme density. This is high density, high volume per range. This is extreme density right here, extremely high volume per range. Okay, but right now you're looking at the raw volume per range input, the raw density. We also have the relative density, which is here. And you'll notice that with each input, there are different sets of properties. So the properties are dynamic and they change with the input that you've selected here. So with the relative density, we're performing the same relative calculation as we do for the relative volume, only using volume per range as the input for the relative calculation. And it's this relative density that you'll notice is actually behind the relative volume bars for each of the bars that has a signal. So for each climax bar, this is a climax bar, a blue bar. If there is also high density for that bar, the density plot will show up behind the relative volume. For instance, right here, this is a selling climax, a minor spike in the volume at a low, and it's also high density. And it's the high density that's telling us that we have demand coming in at this low. And you can even see that as the bar closes up off of its low. Yes, you've got a wide-ranging high volume bar, but the volume is so high relative to the range of the bar that it's even very high volume per range. And that at a low is indicative of demand coming in. It just so happened that that demand failed, knocked it sideways for a little bit, but then it came right back down. So for each of these different climax signals, this is a standard climax, another standard climax. This is an extreme buying climax For each of these, if there is also a density signal for that bar, it will plot behind the relative volume. The option of being able to show both of them from the same indicator on the same panel is what gives us so much more information per bar from a single indicator. And that also helps to single out the climax bars and the churn bars that have that high density, indicating demand at a low or supply at a high. If for a climax bar there is not a high density signal, then the density does not plot. You won't see it behind the relative volume bar. Okay, now what's happening live right this moment, we have a little buying climax that is also high density, and it's also a major spike at a high. So we may have potentially found the end of this little tiny, what could possibly be just a simple little correction before the next move down. Of course, what I'm wanting to see is a little bit higher prices, maybe as high as 60. And then once we break this high at 52, I'll go ahead and get out. For now, I only was able to get into one because I was kind of fumbling around here trying to record this video as the signal was happening, and rather than buying market. So now I'm going to take it up to about 2 ticks of risk and give it just a little bit of room to work itself out here. I'll go ahead and simply just put that order in case it breaks that high very quickly and then rejects. Okay, so I just paused for a little bit so I could edit part of this video to see if this was going to work itself out or come back and stop me out. It is working higher, but it's come back and hit the high here at 52 and stopped. And it's getting pretty late. I mean, it's 9 o'clock at night now. Maybe going to give it another minute, but it's not looking good. It's looking like this is maybe just a little flat correction, like this is part of the next wave down, and this could be just a simple flat before the next push down. So the volume is picking up now. We've got about another 2.5 minutes before this bar closes. Okay, it's looking like it's about to break. Bar just closed, so looks like it's about to happen any second.
Order filled.
Nice. So that's a grand today, just trading 1 and 2 lots in crude oil and NASDAQ. I got I got stopped out at the low here. I got in a little bit too early and then had my stop too tight, but I got in here and then got about a third of the move up today. So, but anyway, it's the volume that we use to confirm the trades that we take. The volume and momentum divergence on the faster time frames to confirm the area that we're trying to trade. And you can see here, this is a 5-minute chart. It's a high density climax bar. It is also an extreme churn bar on the 2-minute. And that's the importance of including multiple time frames in your analysis. And you can see that tiny little bar there where we had the surge of volume come in at the low. You had 3 bars with the same exact, actually 4 bars with the same exact price at the low. So somebody's coming in with limit order buying, absorbing all that selling, huge amount of volume, and then it turns up. And of course, that's where I was trying to get in and then had to chase it a little bit, getting in right in here and then exiting right here. So that is potentially the end of that move. Okay, it's the next day, the 20th of July, and the next input that I want to talk about is the volume per second. So I've just placed a trade here in the NASDAQ at this low. This is just a typical looking corrective swing low, the bottom of a channel that's upsloping and the bottom of a channel that's downsloping. And what we had at the end of this move was a rather fast move in price created by a large number of contracts coming in per second. So the volume was coming in very quickly into the selling climax, which is what the volume per second reveals. So if I hide all of these drawing objects and remove the data about the trade entry, you'll see a couple of these down bars have their bodies painted the color of this volume per second. So in the sub panel here, panel number 2, I have the volume analyst using volume per second as the input, and in the third panel I have the volume analyst using volume as the input. So with the volume, I'm painting the outline of the candles, which includes the wick, but with the volume per second, I'm painting the body of the bar. And just briefly, that's also what the relative volume input does. It paints the outline with the relative volume bar signal color, and then it paints the body of the bar with the relative density signal color. So you see for this big selling climax here, let me blow this up a little bit, the outline and the wick are painted that deep sky blue color, and then the body of the bar is painted with the color of the high density bar. Now you can change that. You could just paint the outline of the bar. If you're using a bar chart, you would have to use one color or the other. But with candles, you can do both. You could paint the outline one color and the body another color. Okay, so there are a lot of different options with the display of the signals, depending on whether you're using bar charts or candles, and then for the drawing objects created by the different degrees of volume spikes. So for instance here, where I started getting into this trade, we had an extreme spike at the low. And anytime you have an extreme spike at a low, from the low of the bar, it will throw off that horizontal line marking the demand line of that bar. And then if you have an extreme spike at a high, as you did here, which was also an extreme churn bar, it will throw off a supply line from the high of that bar until the next extreme spike. But with the volume per second, we're more interested in identifying just these two signals, high volume per second, as we have here, or extremely high volume per second. And typically when you see this extreme volume per second, you've either just broken out of a previous swing high or low, you're right in the middle of a really strong move, or you're right at the end of a move and about to be reversing back in the opposite direction. So at a lot of the little corrective swing lows that we're looking to trade, we'll see this extremely high volume per second, typically with pretty high volume per tick as well, which will show up as one of these spikes in the volume on the tick charts, or potentially a climax bar like we have here, or one of the churn bars like you see here. This bar is actually an extreme churn bar and a major spike in the volume. And then you can see it just kind of drifted sideways to slightly higher, that last bar ending on high volume per second. And then it started to roll over, started moving very quickly down into that first A wave low, and then drifted back up in a B wave. And then once we started approaching the end of this C wave, we get that really strong selling climax with the volume coming in very, very quickly. So that's really all I wanted to cover about the volume per second. This is just an introductory video. We'll have more detailed videos on each of the different inputs. Right now, let's move on to the range input. With the range input, we're identifying 4 different signals. The 2 main signals are the narrow range bar and the wide ranging bar. And there are 2 variations of each. With a wide ranging bar, you may have an outside bar, which has the low lower than the previous low and the high higher than the previous high. For instance, this bar right here. So it's an outside bar, which is a type of wide ranging bar. And then for the narrow ranging bars, it may also be an inside bar, where the high is lower than the previous high and the low is higher than the previous low. So an inside bar is a type of narrow range bar, and an outside bar is a type of wide ranging bar. And then you can have either just a normal wide ranging bar or an extremely wide ranging bar. I won't go into too much detail right now, but just to give you an idea of how this works, there are different look back periods here. So for a standard wide ranging bar, it has to be larger than the past 9 bars. But for an extremely wide ranging bar, it has to be greater than the past 20, but also be above this standard deviation value, 2.5. You could set that to 3 or 4, and you can show the extreme standard deviation band here. The extremely wide ranging bar would also have to be above that 2.5 standard deviation line. We could set that to 3, and then here it's just barely not above it. So now it's just a standard outside bar, not an extremely wide-ranging outside bar. And the number that is displayed here next to the label, OB is outside bar, IB is inside bar, that is telling you, in this case, that it's wider than the past 26 bars. Okay, for this narrow ranging bar, it's actually smaller than the past 99 bars. We cut it off at 99, but you could set the minimum in these lookbacks. So if you want it to be, larger than the past 300 bars for the wide ranging bars, you could set that minimum number here for either one of these. Okay, and you have full control over this. What we can do is actually not show the indicator plot and just plot the numbers. So we could remove the name and just leave the number and the colors, and then plot it on the price panel, same as input series. And now you're seeing just the colors and the numbers, which for instance, this is a wide ranging outside bar that's larger than the past 16 bars. This is a narrow ranging inside bar, which is smaller than the past 31 bars. This is a narrow ranging bar that's smaller than the past 17. This selling climax here, which I bought the end of for this trade, was a wide-ranging, extremely wide-ranging bar that was larger than the past 92 bars. Okay, so this range input can be used on any chart, but if you want to take into account the variance between the overnight and the day sessions and the seasonality between the morning, noon, and afternoon, then you can change the input to relative range. And let's do that now. So I'm going to change this to relative range, and we'll look back the past, let's say 5 days, new panel, and then plot the normal range underneath that, like so. And there we go. So now we're looking at relative range instead of the raw range values. We added this limited view feature to enable the indicator to load even faster when the charts are first starting up or when Ninja is first starting up. And to see the plots further back, you simply have to scroll back to wherever you want to see and then reload the Ninja script. Okay, so I'm just scrolling back so you can see the difference between the plots. You can see the volatility ramping up here into the open, very wide-ranging bars into that climactic low, and then it kind of drops off. Volatility weakens into the lunch session, and now it's starting to pick up a little bit. Okay, so just like with the relative volume and the relative density, for the much larger minute charts, you would want to use the relative range. And for anything smaller than a 10-minute chart, you could use one or the other. You would just have to always keep in mind that you're going to have very volatile, wide-ranging bars at the open, in the US equities especially, and likewise at the close, and then typically less volatility around lunchtime for the US equities, for a lot of the US markets really. So you have full control over all of the different drawing objects, colors. All of the signals can be accessed within a strategy within Bloodhound or Blackbird. And you can really customize this thing to display exactly the way that you want it to. So that's it for this introductory video on the inputs. In the next videos, I'll go into much more detail about the different options and features within each input, and then we'll dive into the signals reader system that we've created for all of our indicators, which allows the signals to be read from any chart from a single chart or strategy. So we'll cover all of that in subsequent videos and wrap this one up here.